Well, hello there, people. Welcome to another edition of Tip Tuesday. This is Geoffrey Nance here with you. Today's topic is options and the risk associated with those. So, even though we teach a full 2-day event on this topic, we'll go ahead and describe a little bit about what they are. Obviously, we're not going to go into the detail that we would there because what you're going to find is that if we spend 2 days talking about it, that must mean that there's a lot of material that we're obviously not going to cover in about 10 or 15 minutes. So let me just start off by telling you a little bit about what an option is. There's two types of options. Those are called calls and puts. And a call is the right to buy the stock at a particular price. A put is the right to sell the stock at a particular price. Now, you can do a number of things with a call option, a number of things with a put option. I think what most people find so fascinating about options in and of themselves is that you have the ability to actually make money when a stock drops. And so when the market's going down on a day like it is today, a put option allows you to actually make money when the market drops. And most people don't even realize that this is possible. They certainly don't really understand how it works. But if you have the right to sell and you wanted to think of it like owning a house, if I have the desire to sell my house and I have a buyer that is already willing to buy it at a certain price, that's essentially what's happening with a put option. I have the right to sell at a particular price. With a call option, I am the buyer. I have the right to buy the stock at a particular price. And obviously, with the calls, you're wanting to buy low. And with puts, you're wanting to see that you're entering that position at a higher price so that as the price drops, you're able to make money there. So, um, those are my two opportunities to either buy a call in the hopes that the stock is going to move up and I'll be able to make my money. You might be thinking, why would I go buy call options when I could just buy the stock? Options provide you significant leverage. So, in other words, if I wanted to go buy $100 stock and I wanted to get 1,000 shares, it would cost me $100,000. Even with margin, it would be $50,000. If I wanted to go out there and get control of 1,000 shares, now shares are bought when you're basically buying the stock, but when you do options, you don't necessarily buy them. You have the right to buy them, but you're basically just in control of them. So in order to have the potential to buy 1,000 shares, it wouldn't cost me $100,000. I could go out there and find an option that might cost me closer to $20,000. Now, you can see very easily there where if I were to control 1,000 shares for $20,000 as opposed to $100,000, that's significant leverage. So that's another real significant upside of being able to trade options, is that I can significantly leverage my money. So I can go get a similar amount of shares, but at a drastically reduced price. So obviously, that is significantly beneficial to me because it does reduce my potential expense. So you say, well, what's the potential expense when I've invested $100,000? You can only lose what you put into that trade, but you put $100,000 into that trade. So in theory, if the stock were to go to zero, you could lose all $100,000. What about with that option? So you only put 20,000 in. What's the most you could lose? $20,000. So it seems like options are very reasonable then. They benefit me because I can make a higher percentage return on investment. And then I would lose potentially less money. So then you got to think, well, what's the downside? There's always a downside, right? There's some balance here. What's the downside there? Well, you can lose a higher percentage faster. All right. So let's just say the stock drops $1. And, if you own the actual stock, you would lose $1 per share. So on 1,000 shares, you lose $1,000. Well, when the option loses about 60 cents on that dollar drop, you would obviously be losing 60 cents rather than a dollar. And you're going, well, that still benefits me. I've lost less. Well, you've lost less, but not from a percentage perspective. So remember, losing $1,000 of $100,000 is a much lower percentage than losing 600 on 20,000. So even though you lose less actual money with the option, you would lose a higher percentage. And that's why we tell people, hey, options are fantastic. They provide you with the great opportunity to leverage your money. You can make a much higher return on investment. So if you get a similar type of move, if you own the stock versus a call option, and that stock were to go up, say, if you own $5, your return on investment is going to be much higher with options than it would on the stock. And so it does provide significant leverage. However, the downside here is that if you're not really aware of what you're doing, that it can go against you and you can lose a higher percentage. Plus, they have an expiration date. So the expiration date, like on your milk or whatever, there's a time when this option is no longer viable. In other words, you have to do something with it. So initially you have the right, but at some point that right becomes an obligation. And so you have to be aware of that. So there is an expiration date on all of these. You can't just hold them forever. Jackie says here, and even if it goes the way we want, we still do not have to buy the stock. That is correct. So what you're going to do with the options is that you're going to treat them as their own entity. So basically, I'm going to buy a call option. If it increases in value, then I'm going to go sell that call option. If I buy a put option and it increases in value, I'm going to go sell that put option. And my profit will be the difference between where I bought it and where I sold it, just like anything else in life. So that could be a car, a house, whatever you want, right? So I bought it at this price, I sold it at this price. Here's how much money I made. So yes, we will treat the options as their own entities. Now, the word option in some circles might be termed a derivative. Now, that sounds much fancier, much more complex, and a lot of the professionals like to use that word. I think there's two reasons why they prefer to go with a word like that. One of them is very practical because it's true, right? It is. So an option derives or gets its value from something else. So the value of my option is directly tied to the value of the stock. So it is a derivative because it gets its value from the stock movement. So in other words, the value of the call or the put depends specifically on what's happening with the value of the stock. So it is a derivative, or it gets its value from what is actually happening with the stock. But I think the other reason they like to use that word rather than an option is quite simply because it sounds more complex. And for many of us, if something sounds hard or complex, we just simply tune it out, go over to the next one. It's like in our, short little meme video culture, we might watch a video, but once it goes past like 30 seconds, we're like, all right, I'm out. I don't have time for this. Let's go on to the next one. So I think one of the things that happens here is when we don't understand things, we have a tendency to just skip past those things. And therefore, if you might understand that it has value, but if you feel like you can't do it, then you're going to be relying upon somebody else to do it for you. Obviously, that benefits people that are doing it for you as opposed to you who is trying to do it for yourself. So, are there risks involved with trading options? Yes. In fact, if you wanted to go out there and just open up a brokerage account, they may or may not let you even trade options. So there will be a certain level of approval that is required. They will make sure there's a series of kind of test questions that they're going to ask you. One is about your risk tolerance. The other one is about your goals and the level of trading that you desire. What they're really looking for when you fill out that application is, do all of those things align? So you say you don't want to take risk and yet you want to trade options. They're going to be like, I don't think you want to trade options. In fact, they consider options trading to be quite speculative. Now, there are ways that you can do that where it does mitigate some of the downside to that. And that's part of what we teach at step 2. In fact, we kind of teach a formula where it allows you to go in there and get a nice return on investment, but still lose a lower percentage when the trade goes against you. So that's one of the things that we teach there at our step 2, which again benefits you. But options trading is a great way to leverage your money. Options trading is a great way to put yourself in a position where you can make money on stocks and in the market as it drops. So I would highly encourage everyone to go learn more about options and how to use those, because it can be a great tool in your tool belt, and we want you to be able to take advantage of that. But it does come with some risk, and we want you to be very aware of that. Our job here at Tradeway is to help you be a more informed and educated trader. So yes, there are tremendous benefits to options trading, but there are downsides as well. So you need to be fully aware of both so that you can go out there and trade options and do so with a knowledgeable brain and the ability to apply those. And like always, all right, we would prefer that anytime you learn something new, whether it's options trading or credit spreads or debit spreads or whatever it is, that you start out with your paper trading account. Make sure you're pushing the buttons correctly. Make sure you understand how the option price is impacted by the movement of the stock. Make sure that you're pushing the buttons correctly. Start out with a small amount of money, and then as you've been faithful with a few things, then go ahead and start doing that with a larger amount of money. Well, guys, that's it for today. So a little bit about options, a little bit about the risk involved with options. And if you want more information about that, get in touch with us, and we'll be glad to help walk you through that full 2-day event as we go into much more detail about how all this works and how it could be a good tool for you moving forward. Thanks for being with us today. We'll see you next time.